Good morning and welcome to the B.F. Anderson Technical Report for September the 23rd. This graph is published by the American Association of Individual Investors. It is a bullish sentiment indicator. You know, as the NASDAQ, which we're going to talk about in a minute, has hit all-time new highs, the amount of positive thinking has deteriorated to levels that are considered bullish. Behavioral finance is all about the study of how individual investors or investors as a group react to markets. And AAII does some very interesting studies. Now, the bullish sentiment, as of the most recent study, basically says that 73% of those surveyed are negative. They are bearish. So you kind of have to ask the question, when do I want to get involved in the stock market? When everything's wonderful and everybody's jumping up and down and cheering, just like the dot-com bubble of 2000 or the housing bubble of 07? You really have to kind of start thinking more like a contrarian. You have to start thinking more like maybe I should do the opposite of what the masses are doing. This is a very difficult thing. If you read the quote at the bottom of this graph, it says, "The most important single factor in shaping security markets is public psychology." And that's a quote by Gerald Loeb, who wrote Battle for Investment Survival, which is one of the best books written in 1935, one of the best books ever written on the subject. Another quote I have on there is, "Your brain is your worst enemy." So the human mind has this unbelievable need to be immediately gratified. And so when you get into bad markets, which is inevitable, you're always going to have bad markets. It's been the way it's been throughout history, and it'll be the way it is in the future. So the question then becomes, how do you handle bad markets? Well, I think it's interesting that AAII did another study where they discussed how long in time, because bear markets not only, or bad markets not only drop in price, but the amount of time that they stay down or continue to drop can be a factor. So in other words, let's say it's like the crash of 87, we dropped 30% in one day, and then within 6 months we're back to making new highs again. That was not that difficult. But when you get into a situation where the time factor becomes a factor, it becomes more difficult. So the AAII study says that the typical investor can only handle a bad market for 18 months before they throw the towel in. Well, I think it's interesting with this particular market that we've had that peaked in March of 14. We are now 18 months into this. Pessimism is high, optimism is low, and the NASDAQ's breaking out to new highs. Go figure. So let's take a look at the market and let's see what's working here. I think it's very interesting here that after two major shakeouts, the fear over China slowing, the fear over Europe breaking up, caused a major shakeout here at the beginning of the year. Then we've had another shakeout here. Now we've rallied to new highs, consolidated, and now we're breaking out, making all-time new highs on the NASDAQ. Now, the reason this is important is that a true bull market is led by companies that are generating earnings. This bear market, the bull market that actually got started in 2009, has been led by companies that pay dividends because they're basically bond surrogates, and the bond market has been outperforming the stock market, which is a rare event in itself. And the fact that interest rates are so low, bond prices have moved up, and people are saying about the Federal Reserve that they're possibly creating a bubble here. I agree with that. I think that the normal level for the interest rates for the 10-year Treasury, according to Alan Greenspan, and I agree with him, is about 5 to 10% a year, and we're currently at 1.6%. So if interest rates normalize and get back up to the 5 to 10% range, those people that are in bonds, that are buying bonds that are paying, 1.6, 2%, are going to have a tough time. Now, this is the S&P 500. As you can see, unlike the NASDAQ, you've got the rally coming up, the consolidation, but you are not breaking out to new highs. Maybe that's a sign. I do think there's a change underfoot here. Now, another indicator we keep a close eye on is the number of new lows, 52-week lows on the New York Stock Exchange. If we go back a year, you can see that over the last year, we've had 8 spikes in new lows, which means that there's a lot of weakness in the market, and there are a lot of companies, mainly energy companies were a big component of that, as well as biotech companies and financials, that were hitting new lows over the last year. So it was dramatic. Anything over 40 new lows a day is something to be concerned about. Well, like yesterday, we only had 21 new lows yesterday. Now, you can see ever since the Brexit situation, the new lows have virtually dried up, and we've gotten very few. We've only gotten one spike, minor spike, in new lows since Brexit. So that's telling me that this market is firming up and that the sellers are drying up, and basically everyone's sitting on a lot of cash out there. And if this thing does get going, we could have something quite dramatic to the upside. We'll just have to see. Now, let's look at some stocks that are looking interesting. I always keep an eye on the IPO market. New companies. This is how our country is going to become better and we're going to get growth going again, is by getting capital to entrepreneurs that are creating new technologies and things that make the world a better place. Now, this is a stock picker's market, I believe, just like the 70s. You want to look for outliers. You want to look for companies that are doing unique things, that have proprietary technologies, that don't have a lot of competition. This also on IPOs, always try to wait 6 months after the stock goes public. Now, in this case, it would have been great to have just bought it right out the chute, but sometimes what happens is you have the insiders who have been building the company for years as a private company, and when finally they get liquidity, they sell some of their shares in order to just change their lives or improve their lives, and you get what you call an IPO slump, which is what happened to Facebook a couple of years ago. So the large telecommunication companies are rapidly moving toward a next generation network called 5G, which is the 5th generation networks. Now, these are going to be optical networks, which will be able to handle more bandwidth as the demand for video has really been going up. I do believe that this company may be taking market share from Cisco, which is the big daddy. Cisco is a $155 billion company. Acacia is only a $4 billion company. So if they become 10% of Cisco, the market capitalization could triple. So this is really a company you should be keeping an eye on. We own it. We'll see. Now, here's a stock that's kind of in the S&P 500 that, to me, is somewhat of the problem. This is Boeing. Now, this year, Boeing sales are going to be down 5%. The earnings are going to be down 18%. The stock, of course, came down, has been consolidating, has broken below both of the moving averages. The 25-day moving average has actually crossed below the 50-day moving average. We did get a bounce here with the market rally this week, but I'm just saying this is not really what I would be looking for. Now, here's another defensive name. Now, this is in that consumer, non-durable area. This is McDonald's, which is basically cheap hamburgers, and it's been in a downtrend, and earnings and sales just are not there. Now, I think it's also interesting to note that China has really come to life here. Their economy seems to be improving. Production numbers have been good. However, not super fast, which is kind of what you're looking for. But as you can see, this China index, which is called the Golden Dragon, has broken out to all-time new highs, and I think you should be keeping an eye on China. Here's another company that we would be watching, a company called Veeva Systems. Now, Veeva Systems is a beneficiary of the cloud computing technology that is really changing things. Sales this year projected to be up 29%, earnings up 18% this year. You see a nice uptrend. The 25-day is above the 50-day. The trend is good. You've had a few little corrections in here, which is normal. Then you've gotten a consolidation, and now you're getting the breakout. Veeva Systems looks interesting. This is what we should be looking for. Now, another one that is on the defensive side, again, this is kind of where the problem in the S&P 500 is. Verizon Communications, telephone, telecommunications. Sales this year down 4%. Earnings will be down 3% this year. Now, realize now the Standard & Poor's 500 this year, earnings are only projected to be up a whopping 0.5%. So what the problem has been for the growth strategy over the last 2 years or 18 months has been that we've been in an earnings recession. Now, we're hoping and we believe that earnings are starting to improve. But with Verizon, you've got the same story as the other defensive names in a downtrend. 25-day has crossed below the 50-day and so forth. Now, on the reason this stock has been popular is it pays a dividend. Now, one thing about dividends that we need to understand, the balance sheet is what this thing is all about. You want to have a company, invest in a company where the book value of the company is rising. So when it comes to understanding accounting, it's quite simple. You have assets, you have liabilities. Then you subtract the liabilities from the assets, and you end up with book value, which is called shareholder equity. So you as a shareholder, when you buy stock, you're paying for that book value on that very day or very minute that you're buying that stock. So when you pay a dividend, what happens is well, in order to increase assets, you've got to increase earnings. So when earnings increase, cash to the company increases. The cash moves to the balance sheet in the form of an asset, and therefore book value goes up. Well, when you pay a dividend, the dividend goes out the door. The cash goes out the door. It becomes a liability, so it's increasing liabilities and not increasing assets. Therefore, the dividend, in a way, you have to understand, it is a yield. It is not a rate. It's not like a bond. So what's really happening in a dividend situation is you're getting cash in the mailbox, but at the same time, your company is seeing a reduction in book value. So it's a wash. I would really recommend that you understand this concept. Anyway, that's in conclusion. Have a good weekend. Mainly the point to remember is the NASDAQ is starting to outperform. That is a growthy thing and a good thing. Thank you.